So today is Opex, obviously. If you guys were on the call last night, some of this will be a replay. It's obviously the bulk of today's morning meeting as well. It's the most important thing going on, in my opinion. And maybe we'll get a little bit of a reprieve today. As you guys know, some of the traditional flows that happen on Opex can be boring. It could be a trend day or it could be a very sideways grinding day. Actually, I'll take a look at the PM position after this call as well. But there may be some similar flows in market that are passive charm type flows like there were yesterday. But I don't expect there to be a strong trend day type rally again. Okay, cool. So back to the recap. Obviously, the path is still pretty much intact. What I would say is that traditionally these big moves, and when I say big moves like 2%, those are associated with implied vols much higher than the levels we're trying to get back down to in order to get things like vol control to relever. And so when you have a 2% rally, it's actually a little bit maybe not constructive in the sense that it doesn't allow a trailing R vol, like realized vol calculation, to normalize and come back down in order to get some of those buying flows to the market. So moves like yesterday probably push out systematic buying, but it probably will come back as things stabilize, but just not quite yet. So that kind of takes a little bit of the flows that I maybe anticipated as being likely into the end of next week and pushes them out a little bit. But as you can see, we've already rallied considerably. And so let's see here. Yesterday's price action, hopefully this was clear. Obviously, some of these are just repeats. Day after day, we see the same kind of thing. So there is a lot of money coming back into the market. A lot of it is systematic, but as you can see, these call walls have acted both as magnetic in the end, but also as a slowing feature in the market. And so they've been a nice thing where there's a ceiling that's very tradable. I know a lot of you guys probably made good money on some of the pins this week, and this is exactly what you'd expect. And it's not the only flow in the market. These will never be perfect maps, but they tell you a lot about imbalances that show up. And this week has been a good week to see some of those imbalances show up, especially in a difficult week to trade, I think. A lot of these maps contribute to the way I look at the market. And often I find that people are confused about what happens or don't understand the ranges. But when you start to understand these forces in the market and build a profile of more and more of them, these things become pretty obvious. And like a 2% up day that stops on a dime or something, or a big rally that stops in its tracks is not a surprise anymore. And so this is a little bit of what we talked about last night. And so 55 half here is just to mark where we were. I'm going to change over to a highlighter here because it was easier to use this yesterday on the call. This is a summation of calls and puts on any given strike because once it's hedged, it doesn't matter if it's a call or a put. This tells you something about the likely influences in the market. Don't pay too much attention to the construction right now. It's a little bit noisy to look at. And even the distinctions here, I don't even need to walk you through them right now because the most important thing is this line here. This is the dealer's biggest long. And no matter how you slice and dice it, there's definitely hedgers that are open on this line on the long side. And so if you guys think back to some of the conversations we've had this week about pinning and how a position can be supportive, but the flows around the position are not necessarily supportive, think about that kind of dynamic through the lens of this chart here. So there's still a $25 differential. To be fair, a proper pin would actually be 55 double in ES. Sorry, double is just like a colloquialism for 55. This level is about the 55.30 pin strike. You can see we've sold through it. We're stabilizing a little bit. And now it'll be interesting to watch and see if we do see something like this. Not saying we will. There are other things in market that happen. But the unique thing about the AM expiration is it's no longer tradable as of the close yesterday. Whereas everything else is pretty much continuously tradable. This one stops trading. And so that position is still in force. And so back to the whole notion about flows not being supportive, but the position is. The position will catch the market if it continues to drop. It's probably catching the market right now to a strong degree. But the passive selling out of long delta, of long futures on the dealer side against option delta, negative option delta from the put side, that is decaying away to zero is distinctly not supportive. So whenever you have a supportive position, the passive flows as the position deteriorates are unsupportive and vice versa. So again, this is the level to watch. 55 in ES should be a magnetic zone. And you can see there's not a lot below it. There's maybe a bit of influence around 5,500 if we continue to sell off significantly. But this should support a lot of this descent. Won't be perfect, but it should be influential. So this is a quick look at today's profile and how it changes. You can see this is just a reflection of what we just looked at. This is around 55.30. This is that dealer long strike. If you guys look up the charm profile and options depth, you'll see a very similar thing. This is going to be a very likely pin zone or pin area. And today's actually interesting because this kind of sets us up for a potential decline, really, where if we do fall significantly out of this range, then some of the stuff that's living up here around 5,600 will be less supportive because the deltas will become too small to have a dynamic influence throughout the day. So as long as these options still have some delta, when I say some delta, I would look around that 20 mark again to distinguish them as relevant. They'll still have an influence to drag some of this inventory up. And I'll put some notes in the chat after I go back into more depth and look through where exactly these calls are coming from, whether it's today or next week. But once we're out of this range, if we do continue to slide in the morning, we may slide into a much less stabilizing map. Now, it's still probably long gamma, much more long gamma than we've been used to if we were down 5% from here last week, but it is not quite as supportive as the range we experienced yesterday. So Leo asks, I assume, Leo, you're asking about this spreadsheet here. Okay, nothing sophisticated. I just pulled what was relevant, in my opinion. So we closed around 55, half in the index, 55.43 or something. And so I just looked, okay, what is most likely in play? And so on the gamma map, I often clip things around 1 or 2 straddle prices. I'll just look at what the 0-day straddle price is or think about some ranges that we've experienced. For example, intuitively, you guys will probably realize too, when you look at a map going into the day, we have had some big ranges, but when the impetus is up, I'm not looking at 5,300 now, right? It's off the table. We can always go back and evaluate it if we start to have a move lower. But for drilling down into what may or may not transpire intraday, I first look within the straddle price and then maybe a little bit outside of that if we've had interesting ranges. But a lot of what you see here too, as far as clipping goes, this is mostly for the presentation as well. And so I have the benefit of knowing what the range was in hindsight, so I can pull out what's relevant from yesterday. I started out obviously looking at the same map that you guys do, which is pretty wide brush, and then I'll just drill down within plus or minus $50 of the at the money. And so again, interesting dynamics. This again would be a little bit supportive if we can stay around here. But if we come into the day and this does not catch us and we continue to fall down here, this will be less supportive. I don't expect a big crash or anything today, but you never know. We've had a big rally. Below 55.30, gamma does come into play, and gamma's coming into play continuously. And so the reason it's like a knife catch is because these options are very close to expiring, and they're the only options really that are relevant at the moment. Obviously, the S&P dwarfs the entirety of the option complex, and the AM expiration is still a very significant part of that. Ironically, people have not moved over to PM settlement, despite it's just so much easier to trade from anybody's perspective, but people are stuck in their ways. But you can see here, if you guys pull up, let me do this real quick. I don't have a way to share futures very easily, but you can look at right now, the price action is climbing back up to 55.46, 55.45. And so we did drop through the strike, which is interesting because I would expect it to be more supportive than that, but it does look like price is stabilizing. And we may see a little bit of a charm pin. And I don't know who owns these calls. It's interesting to me to see that it's a pretty big block as far as being carried into expiration. I will spend some time, probably not today, I won't get to it, but I will spend some time this weekend pulling through notes and the evolution of the inventory and try to drill down to figure out if this was a systematic type sale or if this was something that was opened and left there, and verify with some of my contacts what kind of flow it is. But it is interesting to see us land very close to really one of the largest dealer longs on the map, especially after a significant range where you expect to have a lot more in play. but it's like a bullseye settlement in my view. So PM pinning example. Let's see. I should have this here still. I'm not sure which pinning example you're talking about, but okay, maybe this one. If you guys can see the strikes here, one more forward. This one or the other way? Okay. Yeah, this is a little bit old. This is July 24th. But what had happened on this day was we sold off into a range where customers or clients, end users, were long something that looked like this here. And I'm simplifying a little bit, but they're long the 54 half puts and they're short the 54 30 puts and a little bit of noise below it. But basically a put spread. They're long a large put spread. Dealers are short the put spread, customers long. So because dealers are short the put spread, I know sometimes you guys are used to saying things like put credit, put debit. To me, that sounds completely wacky. I'm sorry if I don't ever adapt to that. But when I say short the put spread, I just mean exactly that. 54.30, 54 half put spread are shorted. That means they have a short on the 54 half line and a long on the 54.30 line. When we get here, this range, this is a colorful map, meaning that actually color comes into play. Gamma evolves throughout the day, and suddenly a range that is benign becomes increasingly negative gamma, neutral, and then negative gamma. And so holding above this strike is important. Why do I say that? If we are trading 54.52, for example, and we just keep grinding sideways, time passing but nothing happening, then those puts are 50 delta most of the way, but they're going to start decaying even when they're so close to the money. And that decaying will require market makers to start buying back some of those futures that they are short against the puts. Because as they go from a 40 delta to a 37 delta to a 35 delta, etc., that will start to accelerate as well. And they will, if they're the only force in market or the dominant force in market, that flow produces an imbalance that has the effect of two magnets of the same direction pushing off one another. And their flows here would, in theory, support the market. I know it sounds strange because there's negative gamma, but charm is what is supporting the market here because gamma requires an impetus. Gamma does require someone to start the party, and dealers have to then chase their tail, for lack of a better term, buying or selling futures in the direction of travel. But in this case, charm itself can force the dealer to start buying futures, which of course then would potentially mean the dealer has to buy more futures if we move off their own flows. But usually charm is pretty continuous, and unless you have some discrete big blocks in the market, usually it's pretty continuous. But if you come below it, it's the same thing. 54 half breaks, and so the thrust is the opposite direction because these puts go from 55 delta to 60 delta to 70 delta to 80 delta, 90 delta, just because time is passing, not because the underlying is moving. And so charm itself then forces dealers to start pushing off the strike to the downside. You can see that if anybody ever says that pinning doesn't depend on direction, they have no idea what they're talking about and have never actually managed a derivatives portfolio because pinning explicitly depends on whether you're long or short the strike. Anti-pinning happens when a dealer is short the strike. So in this case, it looks like there's actually some negative gamma flows that kicked in here. But then the sideways influence, here again, is a little bit of negative gamma. And this is a very unstable place for dealers. Whenever you're at this transition point where there's long gamma on one side and short gamma on the other, it's super sensitive to implied vol changes and charm. And so there's a very erratic kind of gyration that happens in a portfolio's delta. But effectively, the opposite of what I just explained here begins to happen here. They're on the 54, or sorry, let's just say they're between these two strikes. They're trading 54.40. Their position is working against them in both directions because they're between them. So on the top side, these puts that may be 70 delta are becoming 75 and 80 and 85 and 90, but they're only hedged from 70. So they need to continuously catch up discretely to what's happening with these puts by selling more futures. On the opposite here, these puts are still out of the money. They may start as 30 delta puts that are hedged with long futures, but as time passes, they go 30, 27, 24, 22, 20, 20, whatever. The same thing happens. They have to continuously catch up by selling out the futures that they hold against these puts. So both positions moving in the same direction. And this is again why you'd call this position supportive, because you can see it catches the knife here in the end. I know this is very small to look at on my screen, but if you guys have it, you can probably zoom in yourselves. It catches the knife, and that's the support of gamma. That's important. But at the same time, this decaying of the position requiring the passive selling of futures is not supportive. Now, if this spike kept going, for example, we could have overshot and gotten through the strike very easily. And then the same thing would have worked to support the market, because once we're through it, the charm would have kicked in the other way as well. But it wasn't enough. And so obviously it's still negative gamma, but it didn't quite get us through the strike. And then the next kind of move from any kind of external participant, if it's selling futures or bringing negative delta to market, dealers are quickly turned around and have to chase it down the other way. And once we're here, this is a large position. It is like an undertaker. It's the most miserable thing to have as a dealer when nothing else is happening, because it kills you in two ways, because obviously skew. So what's not clear here is that the implied vol of this strike is higher than this strike. And so it really sucks to wind up in between these in a situation like this. It's an undertaker for a couple of reasons, because you wind up hitting your strike, but it's also implicitly expensive. You're long the more premium intensive option that rotted away, and you didn't get paid for it. Yeah, so just to be clear, there's some gamma in force, negative gamma in force here. But then because we went below the strike, we slipped below the strike, that tends to continue this really repulsive movement lower, and this becomes more magnetic. And so this one is a magnet. This one actually pushes away. And we may have that happening now. As futures stabilize and climb back up, I would expect the same type of dynamic, assuming this positioning is, we know it's accurate, we know it's correct, but assuming the hedging constraints generally hold for whomever holds the inventory. And when I say that, obviously the dealer community is a ton of entities. You can't make a perfect assumption about what's happening with this position. You can just generalize, but there's always edge cases with that. There could be a reason somebody needs to hold a lot of these puts by themselves, but generally that's not the case. PS says, but don't the AMSPX puts dealers are long expire at the open? Exactly. So all of this that we're talking about now, this is a different day, but all of this stuff disappears, and that's why options depth is, I think one of the guys on here asked me a question on Twitter in a DM last night. Hopefully he's watching this. He mentioned something about the gamma unclench and being able to see what happens at the AM expiration. Maybe this wasn't available yet at the time in their platform, but you can see now pretty clearly. This is literally, this vertical here is literally expiration. This is when this inventory disappears. And to be clear, everything that's on this map here is still in force here. So this is all PM here. This is all AM. I don't know what I'm drawing here, but whatever. Everything here is still active here, but this is effectively like 0-day positioning. It's just that the 0-day expiry is coming up in 12 minutes, if that makes sense. What do I expect to happen in PM as a result of the unclench? This looks like a day just like any other throughout the week. If whatever the selling flow is before the open doesn't stabilize, now it looks like it's stabilizing. It looks like we're having a charm pin, and there's going to be a lot of transacting on the open. Hopefully it balances out. If it does balance out and we don't really give up this range here, if we don't really slide below, let's say 5,500, it's a nice round number, I would expect that we would have a levitation, as this would be indicative of charm flows that require buying. It's not a guarantee. Yeah, so there's two things going on. There's the AM set, the SAQ, there's opening rotation. So the options expire technically at 9:15. It's a weird thing, but effectively they expire at 9:30. The actual settlement value, though, is not yet known until every constituent goes through its opening auction rotation process, and that's the SET that Jack was talking about there. So the options expire, they're gone, but their valuation is not determined until the resolution of all the different constituents processes. That's why you don't ever get a print or a settlement right at the open. And that's why if you're ever like, you guys probably don't know this unless you're in the industry, you'll get messages passed around on Bloomberg all the time, like SPX settlement, like 55, 32, 74, 78% official. And it just keeps climbing as the different constituents resolve this process. And then eventually you get the official print, which is the affirmation that every individual equity in the index has gone through its opening rotation. The process is done, index is calculated, and all of those options that just expired now have a reference value against which to value every position and send cash to the accounts. Yeah, I'm also surprised that the industry has not moved to PM expiration. It works so much better in so many ways, and the ability to trade out of positioning until the moment it expires is a huge benefit to dealers carrying the positions and end users too. There must be a vested interest. I've always found that there are clear vested interests that I'm not privy to what the end rationale is, but when there's big money in the market to get their way, when I first started trading, I was told that the floor would be done in 2 years. And then 5 years later, the floor would be done in a year. And 10 years later, the floor would be done in a year. I'm like, oh, the floor is never going to be done. If the floor survived COVID, the floor is not going away. Opening rotation could take a long time. Usually it's done within 15 to 30 minutes, but I've seen it take hours. Oftentimes that means there's a problem with one of the constituents. Usually it's fast, just like I said. These opening rotations should also tend to be a little bit more erratic. The CME introduced the BTIC, the Basis Traded Index Close contract, years ago. It was brilliant when they did it. I was so happy. For a long time, too, a lot of market participants didn't even know it existed. And so you could actually arb other market makers who are not aware that you had a way to resolve your delta imbalance at the close. You could just call up and quote the SPX, any kind of roll, and then arb them if they were off. Everybody got wise to it eventually. But they also added something called the TACO, which is, I think, the trade at contract open or something. It's just not as liquid. So that's why in the chat I asked about an MOO imbalance. I think there's a service called Mr. Top Step or something that calculates these imbalances. And sometimes on the AM serial, you do get some interesting market on open imbalances. And often they're probably reflective of hedging needs of market makers. Cool. Yeah, I'm going to end here and wrap up. It's getting close to the open. This weekend we'll have another Q&A tomorrow at 2 p.m. for the VIP mentorship guys. So good luck if you're trading. I'll post the official settlement as soon as I get it from somebody that I trust.